The global oil market is on the brink of a new era, and what you don't know could cost you. In 2026, crude oil isn't just reacting to supply and demand anymore. Structural shifts, geopolitical tensions, and technical market forces are colliding in ways that could make the next price moves unpredictable and potentially explosive. Today, we break down everything: why OPEC's influence is waning, how US shale is reshaping power, the hidden risks from Iran and Venezuela, and what technical charts are telling traders right now. If you want to understand the oil market in 2026, this is the video you can't miss. Let's start with the big picture. OPEC. For decades, the Organization of Petroleum Exporting Countries had the power to move oil prices almost at will. But that era is fading. In the mid-1990s, OPEC accounted for nearly 40% of global crude production. Today, that number is around 36.2% according to the 2024 OPEC Annual Statistical Bulletin. Why the decline? The main culprit is the US shale boom. In the early 2000s, US production hovered around 5 to 6 million barrels per day. Fast forward to 2025, and US crude output has surged to a record 13.6 million barrels per day, and projections show it will stay around 13.5 million barrels in 2026. Non-OPEC producers have become more agile, ramping up supply when prices rise, which limits OPEC's ability to sustain higher prices without losing market share. Even the broader OPEC Plus alliance isn't immune. Their combined share of global supply has fallen from 53% in 2016 to an estimated 46% in 2025 to 2026. With global liquids production expected to climb from 105.9 million barrels per day in 2025 to 107.2 million in 2026, OPEC's strategy has shifted from aggressive market tightening to managing volatility and inventory levels. Now, let's talk geopolitics, because oil and politics are inseparable. The biggest wildcard is Iran. Positioned near the Strait of Hormuz, Iran can disrupt nearly 20% of global oil trade with just a few strategic moves. Historically, any flare-up between Iran and the US would trigger panic buying. But here's the nuance. Markets have learned to price in risk rather than panic. For example, in January 2026, Brent crude spiked to $66.82 amid rising tensions, only to retreat over 4% to $63.6 once fears subsided. Iran's potential pre-sanctions export capacity is around 2 million barrels per day. Against global demand of roughly 105 million barrels per day, that is significant, but not enough to trigger a sustained supply shock. Bottom line, geopolitical tensions are now more of a volatility catalyst than a trend driver. Expect short-lived price spikes rather than long-term rallies, unless a major disruption occurs. It's not just politics. Physical oil flows from Iran and Venezuela face real logistical and quality issues. Venezuela's heavy crude is hard to refine, and Iranian exports are constrained by sanctions and infrastructure. Even if both countries suddenly ramped production, the actual impact on global balances would be limited. The market now reacts more to the perception of risk than actual supply disruption. This is a key point. The oil market in 2026 is as much about psychology as barrels. Traders watch headlines, anticipate threats, and react quickly, but fundamentals remain anchored by US shale and other non-OPEC supply. Let's turn to technicals, because they're shaping day-to-day price behavior. Over the past 2 years, oil prices have been consolidating. Breakouts above resistance have repeatedly failed, while downside moves are cushioned by production cost floors, especially from US shale. WTI crude is now forming a medium-term range. Upside is capped by hedging and incremental non-OPEC supply, while downside is supported by cost-based production responses. Momentum indicators show weakening trend strength, meaning traders don't have strong conviction in any direction. What this tells us, we're in a mean reverting, volatility-driven market. Each rally or drop is likely temporary. Expect sharp swings rather than sustained moves. Even geopolitical scares, like tensions in the Strait of Hormuz, may cause brief spikes that quickly fade as supply adjusts. So, where does this leave us for 2026? The market is range-bound, but reactive. Expect short-lived rallies when geopolitical risks flare, pullbacks as U.S. shale and other non-OPEC producers increase output. Price floors reinforced by marginal production costs. A persistent geopolitical risk premium embedded in oil prices but without sustained upward trends. OPEC's declining influence, flexible non-OPEC supply, and the technical consolidation pattern suggest that traders should focus on volatility plays and range strategies, rather than chasing breakout trends. But the oil market is never one-dimensional. Let's explore some alternative scenarios that could disrupt the range-bound setup. Scenario 1. Major geopolitical shock. If tensions near the Strait of Hormuz escalate beyond current skirmishes, say a blockade or direct conflict, prices could spike sharply, potentially reaching levels not seen since the post-pandemic rally. However, even then, non-OPEC producers like the US and Brazil could respond by tapping inventory and increasing output, likely limiting how long the spike lasts. Scenario 2. Supply glut from rapid shale response. US shale is extremely nimble. If prices hit levels that justify additional drilling and production, we could see an overshoot on the downside. This means temporary rallies might be followed by sharp retracements, keeping the market in a volatile, oscillating range. Scenario 3. Energy transition impacts. Don't forget long-term trends. Renewable energy adoption, electric vehicles, and efficiency gains in industrial demand could slowly erode oil's share of global energy consumption. While this won't trigger dramatic swings in 2026, it adds a subtle downward pressure to prices over time, particularly on non-premium crude grades. So what does all this mean for traders and investors? For short-term traders, expect sharp, news-driven swings. Use volatility to your advantage, but avoid betting on sustained trends. Range trading strategies and options for hedging may perform best. For long-term investors, structural shifts matter. OPEC's declining influence and flexible non-OPEC supply mean oil is less likely to surprise to the upside. Diversifying across energy sectors, including renewables and integrated oil majors, could reduce risk. For consumers and businesses, fuel costs will likely fluctuate in the medium term, but there is less risk of a sustained price shock unless an extreme geopolitical event occurs. Hedging strategies for transport-heavy businesses remain important.